Looking at Oracle Corporation today on April 21st, 2026, are we looking at a falling trend, flashing sell signals, or a deeply undervalued strong buy?
Honestly, it is the ultimate Rorschach test for the market right now. Because depending entirely on which metric you prioritize, you are seeing like a completely different reality for this company.
Yeah, that makes sense. And before we get into those metrics, we need to be crystal clear with you, the listener. What we are having today is a natural human debate about the data we've sourced.
Right. This is absolutely not financial advice.
Exactly. We are analyzing the mechanics of a company in transition, not telling you how to manage your portfolio. So if you're joining us on YouTube, make sure to like the video, subscribe to our channel, and it is compulsory that you leave your feedback in the comments.
We really do want to hear from you guys.
We do. Okay, let's unpack this. Oracle is currently trading right around $179.12. It's up slightly for the day, but it is sitting in the very dark shadow of its 2025 all-time high of $345.72.
Yeah, and you don't lose that much market cap over a single bad earnings call. I mean, dropping from 345 down to a 52-week low of $121.23.
That's brutal.
It is. You are witnessing a fundamental repricing of the company's entire future.
Which is exactly why our mission for this deep dive is to unpack this highly volatile technical recovery on the charts, dig into the massive AI backlog, and figure out what these wildly conflicting signals actually mean for retail investors.
You really have to start by looking at the bedrock. You can't understand the erratic price action today without understanding the balance sheet.
Right, let's pull up that income statement. Because at first glance, it honestly looks pretty traditional for a legacy tech giant. I mean, fiscal year 25 annual revenue is up 8%.
Yeah, sitting at over $57 billion.
Exactly. And the trailing 12-month net income is a very healthy $16.19 billion. Earnings per share are hovering between $5.57 and $5.90, and they're still paying a modest dividend yield of 1.13%.
You read those top-line numbers, and it paints a picture of a mature, stable company, right?
Yeah, steady revenue, billions in net income.
But that is, it's an illusion created by looking in the rearview mirror.
Because when you flip over to the cash flow statement, the illusion totally shatters. The free cash flow as of the February 2026 report is negative. And we aren't talking about a small deficit here.
No, not at all.
We are talking about a massive negative $24.7 billion. Add to that a staggering total debt load floating somewhere between $134.6 billion and $162.17 billion.
It's just wild.
It's like looking at a wildly successful restaurant with a line around the block, but you find out the owner took out a second mortgage and maxed out their credit cards just to build a bigger kitchen.
That is a perfect analogy. And what's fascinating here is why that debt and that cash burn exist. This isn't a company blowing money on frivolous acquisitions,
Right, it's going somewhere specific.
Exactly. That negative $24 billion is directly tied to RPO, or remaining performance obligations.
And for you listening who might not track RPO regularly, that basically means contracts that have been signed, but the service hasn't actually been delivered yet.
Yet the revenue hasn't been recognized. It's their backlog. And Oracle's Q3 fiscal year 26 backlog is $553 billion.
Wait, $553 billion?
Yes. That number has grown by 325%, driven almost entirely by raw demand for AI infrastructure.
But having a $500 billion backlog isn't revenue, it's an IOU. I mean, the line around the block is real, but the cost to serve those customers is threatening to sink the whole operation.
And that tension is exactly what is bleeding into the technical charts today. The debt is current, the cash burn is right now, but the revenue is just a promise.
Let's talk about those charts, because that fundamental tension is causing absolute whiplash. The stock is up about 9% in the last 5 days.
But year to date, it's still down 9%.
Right. And what stands out to me is the volume. In the early trading session today, volume is remarkably light. We're seeing fewer than 176,000 shares traded compared to a 10-day average of over 35.5 million.
Yeah, low volume is, well, it's like walking on a frozen lake. The ice is thin. A 9% pump on low volume suggests a severe lack of institutional conviction.
The big money isn't stepping in.
Exactly. They're holding their breath.
And the technical indicators are screaming caution, too. The Relative Strength Index, the RSI, is flirting with overbought territory, sitting between 67.32 and 70.45.
Right, which mechanically means the buying pressure that drove that recent pump is exhausted.
And then you look at the MACD, which is at 4.35, and it's flashing completely mixed signals. But what about the moving averages?
Well, the moving averages tell a much clearer story about the institutional battle lines. The short-term moving averages, the 20-day and 50-day, are acting as a bullish floor right around the $150 to $151 level.
But the 200-day moving average is way up at $214.85.
Acting as a massive bearish ceiling. Institutional risk models literally treat that 200-day line as a strict de-risking zone.
So the stock is trapped in a vice. We've got support establishing itself at $163, which is a broken double bottom, and another layer of support at $173.
But the immediate resistance is at $188.
Right. And every source indicates that if Oracle can break $188, that's a major positive signal. But with volume this light, who's actually buying right now to push it there?
You have to look at the institutional tug-of-war behind the scenes. On one side, you have JP Morgan. In mid-March, they upgraded Oracle to an overweight rating.
Which acts like a flare gun for institutional buyers.
It does. It forces index funds and portfolio managers to reallocate, creating buying pressure. But JP Morgan is fighting directly against early March price target cuts from Mizuho and Barclays.
Who are looking at the exact same balance sheet.
Exactly. They see the massive debt, the negative cash flow, and they are screaming danger.
Which officially categorizes the trend direction as bullish short-term, but bearish long-term. It's a totally divided market.
Completely.
And that brings us to the great debate. The most critical question for you, the listener. Is this stock actually a deeply undervalued opportunity, or is it a textbook value trap?
If you look solely at Wall Street consensus, it's overwhelmingly bullish. About 83.3% of analysts have buy equivalent ratings.
Calling it a strong or moderate buy.
Right. The average price target is $243.87.
Which is a massive upside from $179, but the range on those targets is wild. I mean, you have lows at $155 all the way up to a staggering $400 price target from Guggenheim and Mizuho.
Yeah, $400 is aggressive.
How do they justify that? They are pointing to a PE ratio of 31. How is a PE of 31 considered cheap for a legacy company with $150 billion in debt?
Because they argue you cannot price Oracle like a traditional database company anymore. If they capture that $553 billion backlog, 31 times earnings is actually a bargain for that level of hypergrowth.
Okay, I understand the theory, but I struggle with the reality, and this is where the value trap case comes in. Our sources brought up the guru-focused discounted cash flow analysis.
Oh yeah, the DCF model.
Right. For those unfamiliar, a DCF analysis tries to figure out the true intrinsic value of a company today based on projections of its future cash generation.
And here's the crucial mechanism of a DCF. It heavily penalizes negative cash flow.
Because negative cash flow means you are destroying present value to fund future growth. And considering their free cash flow is negative $24.7 billion, that calculation is going to be brutal.
It is. The guru-focused DCF places Oracle's intrinsic value at just $112 per share.
Wow. So at $179, it isn't trading at a discount at all. It's at a premium.
Based entirely on the assumption of future perfection. And this is exactly why retail traders get trapped. They anchor to the $345 all-time high, they see a big backlog, and they buy into the hype.
Ignoring the underlying valuation mechanics.
Exactly.
Which raises the ultimate question, can Oracle actually achieve that required perfection? Let's lay out the concrete risks, starting with the bear case. To fund this AI expansion, Oracle has set a capital expenditure target of $50 billion for fiscal year 26.
$50 billion in 1 year. That is an astronomical amount of capital to physically deploy. How do you secure the GPUs, the land, the power contracts for that much infrastructure in 12 months?
Especially while carrying so much debt. And it comes with a severe organizational cost. Restructuring news reveals they're cutting roughly 30,000 jobs globally.
Yeah, gunning their legacy departments to feed the AI machine.
When you fire 30,000 people, morale tanks. You introduce massive operational chaos right when you need perfect execution.
Plus, you introduce security risks. The sources specifically cite recent reported data center attacks in Dubai.
Which is huge because if you are building a centralized hub for global AI processing and your infrastructure is vulnerable, that threatens the entire backlog.
Enterprise clients won't hand over proprietary AI models to a landlord who can't secure the building. The bear case is basically that Oracle is running a desperate race against its own balance sheet.
If the negative cash flow catches up with them before the backlog is realized, the stock continues its slide down to that $112 intrinsic value.
Yeah, and the downside volatility will be extreme.
But let's flip it. Here's where it gets really interesting with the bull case. Oracle isn't building blindly. They are positioning themselves to be the foundational layer of global AI.
Right, they've secured strategic partnerships with AWS and OpenAI.
They aren't just participating, they want to own the ground the AI boom is built on, which is why they raised their fiscal year 2027 revenue guidance to $90 billion.
That's a massive leap from the $57 billion they're doing now. The bullish argument is that the $50 billion in Capex and the 30,000 layoffs aren't distress signals.
They are signs of a ruthless management team.
Exactly. Willing to endure short-term pain to dominate the next decade.
So, synthesizing all of this, what's the outlook? We have a stock that could drop to $112 if they stumble, or rocket to $400 if they execute.
Market sentiment is cautious but hopeful regarding the AI pivot. But in the short term, expect continued choppy volatility.
With an upward bias testing that $188 resistance, right?
Yes, but long term, success is entirely dependent on converting that $553 billion backlog into actual revenue while juggling that debt. If they do, the all-time high is back on the table.
It is arguably one of the most high-stakes corporate tightrope walks we've seen. And that brings us to the end of today's deep dive into Oracle. Make sure to like, subscribe, and leave your comments.
We really want to know what you think.
Absolutely. And I want to leave you with one final thought. Oracle just cut 30,000 jobs to go all in on funding AI data centers while carrying massive debt. Are we witnessing a brilliant strategic sacrifice that will return this stock to its $345 all-time high? Or is this a desperate, volatile gamble that will leave retail investors holding the bag? Let us know what you think in the comments.